If you're managing your own money, you might look at the towering glass and steel skyscrapers of Wall Street, the absolute armies of Ivy League analysts, the supercomputers humming in the basement trading in literal microseconds, and, well, you might think you're at a massive disadvantage. It feels like you're bringing a knife to a gunfight, right? But what if I told you the exact opposite is true? Seriously, you actually possess a profound structural advantage over Wall Street's absolute largest funds, and it's an edge built right into the cold, hard math of the market. Welcome to this documentary mini course. Over the next bit, we're going to break down exactly what that edge is, where it hides, and how you can wield it to completely outmaneuver the giants. The core philosophy we're diving into today comes straight from the brilliant, battle-tested thinking of investor Joel Greenblatt. And the overarching thesis of his work, it's incredibly empowering for the everyday person. It boils down to this. Wall Street's biggest funds have a critical, undeniable weakness. And entirely because of your smaller size, you have a distinct, quantifiable edge. So throughout this journey, we're going to unpack 5 specific, deeply actionable ideas that show you exactly how to exploit that institutional weakness and, turn it into your personal gain.
We're going to tackle this in 5 equal chapters. First, Chapter 1, play in a different league. 2, skip the precise valuation. 3, the hidden index flaw. 4, build your value index. And finally, Chapter 5, tie yourself to the mast. Let's just dive right in. Chapter 1, play in a different league. The structural advantage of the small investor. You see, you don't beat a heavyweight by getting in the ring and boxing him. No way. You beat a heavyweight by switching weight classes entirely. Imagine a mega fund managing, say, $50 or $100 billion. Mathematically, they just cannot meaningfully invest in a fantastic little company worth $200 billion. If they buy too much of it, they legally have to take over the whole company. And if they just buy a small, safe amount, and that stock doubles or triples, the total profit is literally a drop in the ocean for a $100 billion fund. It doesn't move their overall performance needle one single bit. So these large funds are corralled, not by choice, but by sheer mathematics and liquidity rules, into a shrinking pool of mega-cap stocks. They're all fishing in the exact same, highly competitive, heavily analyzed pond. But for you, the individual investor, the field is wide open. There are thousands of companies globally that are virtually ignored by professional analysts simply because covering them isn't profitable for a massive institution. And where there are fewer eyes, well, there's more mispricing. And mispricing is exactly where your excess returns come from.
The ultimate equalizer here really just comes down to percentages. Let's say you find a great underfollowed microcap company and it yields a 12% annual return. That 12% counts exactly the same in your brokerage account as a 12% return scraped and clawed from a heavily contested mega-cap tech stock. The profound difference? You faced a fraction of the competition to find it. Now, we should definitely clarify something. Small companies aren't automatically better businesses. Lots of them are terrible, poorly run companies making obsolete products that, frankly, deserve to be ignored. The advantage is just that the field is less picked over. That means a genuinely good, mispriced opportunity is way more likely to still be sitting there, entirely unnoticed by the big players.
Actually, there's a natural tension here that we need to acknowledge. This structural edge shrinks as your own capital grows. If you're incredibly successful and compound your money year after year, your portfolio will eventually swell to a size where you too are going to graduate out of the smallest, least covered companies. At a certain scale, your own trades will start artificially moving the stock price. Now, that's obviously a wonderful problem to have, right? But it does mean this specific advantage has an expiration date. You absolutely must use it deliberately and aggressively while it's still available to you.
Chapter 2. Skip the precise valuation. Why relative ranking beats the illusion of precision. If you crack open any standard finance textbook, it's going to tell you the proper academic way to value a company is a discounted cash flow model. The textbook method demands you project every single dollar a business will generate from now until the end of time and then discount it back to today's value. In a vacuum, sure, the logic is flawless. The problem? The inputs. To make that model work, you have to accurately forecast a business's earnings for 10, 20, sometimes 30 years into the future. Honestly, think about how absurd that is. Highly paid professional analysts struggle to predict what the Federal Reserve is going to do next Tuesday, let alone forecast a company's exact profit margins in the year 2054. When you build a discounted cash flow model with highly confident assumptions, you haven't found the truth. You've really just built a very precise-looking guess. So what do we do instead? We need a practical workaround. Instead of pinpointing an exact dollar value and pretending we can magically see the future, we shift entirely to relative comparison. And we start with a really simple foundational filter. On one side, consider the earnings yield, which is roughly the company's earnings divided by its current stock price. This tells you the cold, hard return the business is actually generating for you today based on what you pay. On the other side, consider the 10-year Treasury yield. That's the government bond yield, which is practically guaranteed and risk-free. This government bond is your baseline hurdle. Think of it this way. If a business cannot currently out-earn a safe, risk-free government bond, why on earth would you take on the wild volatility and uncertainty of owning its stock? You wouldn't. This single brutal filter quietly eliminates a massive amount of hyped-up, overpriced market darlings that honestly have no underlying economic substance. Once you've eliminated those immediate losers, you follow a remarkably freeing two-step process. Step 1, like we just said, is clearing that minimum bar, beating the risk-free rate. Step 2 is simply to rank what's left on a shortlist. By doing this, we're lowering the bar. We're moving from a complex, impossible precision contest, trying to prove a stock is worth exactly $47.30, to simply being more right than the person on the other side of the trade. You don't need to be an oracle. You just need a repeatable, honest way to rank realistic options against each other. Is Company A fundamentally a better deal today than Company B? Now that is a grounded question you can actually answer.
Chapter 3. The Hidden Index Flaw, the Mechanical Error in Cap-Weighted Funds.
Okay, we need to expose a massive mechanical error operating right inside the most common investment vehicles in the world. Look, low-cost index investing is generally fantastic. It saves you from the exorbitant fees and consistent failures of active stock pickers. But there is a structural flaw hidden inside the default version of the index fund, the market cap-weighted index. Here's the mechanism at play. In a cap-weighted index, a company's slice of the pie is strictly determined by its total market value. So, as a stock's price skyrockets and it becomes a speculative market darling, it automatically becomes a larger and larger percentage of the index fund. When millions of regular people automatically deposit part of their paycheck into their retirement fund every 2 weeks, the fund mechanically funnels more and more of that new cash into the most expensive stocks. And conversely, when a stock's price falls, even if the underlying business is still highly profitable and doing great, the fund mechanically shrinks its exposure to it. Think about the fundamental irony here. The fund is blindly programmed to do the exact opposite of the golden rule of investing. It buys more as things get pricier, and it sells as things get cheaper. It is literally the ultimate momentum trade masquerading as passive investing.
So if cap-weighted funds are structurally biased to buy high and sell low, how do we fix it? Simple. We change the sizing mechanism entirely. One alternative is equal-weighted indexing. Instead of sizing by market cap, you just put the exact same dollar amount into every single holding. Boom. You instantly break that dangerous feedback loop of price momentum. The other, perhaps even more powerful alternative is fundamental weighted indexing. Here, you size the position based on actual, tangible business metrics, things like the cold, hard cash the business makes, its top-line revenue, or the dividends it pays out, completely ignoring the stock's fleeting popularity or its current market price.
And why does this mechanical shift even matter? Because independent, long-run research spanning multiple decades and thousands of stocks reveals something absolutely incredible. These alternative weighting methods provide a persistent performance edge. We're typically talking a few percentage points annually over standard cap-weighted indexing. Now I know, a few percentage points might not sound like a blockbuster movie, but when you compound an extra 2 or 3% over a 20 or 30-year investing lifetime, that seemingly small gap translates into absolute fortunes in actual dollar terms.
Chapter 4. Build Your Value Index, the magic formula of cheapness and quality.
If fundamentally weighting a broad index beats the standard method, why stop there? Seriously, why not push the logic one step further and build an index explicitly designed to hunt down the absolute best opportunities? To do this, we need a dual ranking system built on 2 essential pillars. Concept 1 is cheapness. We can easily measure this using the price to earnings or PE ratio. Simply put, how much are you paying for each dollar of profit? A lower PE means you're paying less for the exact same earning power. But listen, cheapness alone is a devastating trap. Buying a cheap business that is actively melting down is just catching a falling knife. So we desperately need concept 2, quality. We measure this through return on invested capital. Basically, how efficiently does this company turn money into more money? How much pure profit do they squeeze out of every single dollar tied up in factories, inventory, and daily operations? The true magic happens when you bring these 2 forces together. You rank the entire universe of available, small, ignored companies by how cheap they are. Then you independently rank them all by how high quality their business operations are. Combine those two lists and buy the companies sitting right at the absolute top of the combined ranking. This ensures you are buying businesses that are simultaneously undervalued by the market and genuinely exceptional at generating wealth. This mechanical backbone is widely known in the financial world as Greenblatt's magic formula, and in rigorous published backtesting spanning over 2 decades, it meaningfully outperformed both broader markets and simpler strategies.
But, and this is probably the most critical caveat of all, you really have to read the fine print here. The historical outperformance shows up in the long-run average. It is absolutely not a smooth, uninterrupted climb. This strategy will lag behind the market for stretches, sometimes for years at a time, especially when overpriced, hyper-growth stocks are all the rage, and it feels like your neighbor is getting rich on meme stocks while your value index just sits flat. This is the ultimate test. A strategy that wins brilliantly on average is completely, utterly useless to you if you panic and abandon it during the inevitable rough patches. Chapter 5. Tie yourself to the mast. The behavioral discipline needed to survive.
You know, clever formulas and hidden structural advantages mean absolutely nothing if human psychology completely hijacks the process. The biggest obstacle to your wealth isn't the Federal Reserve, it isn't high-frequency trading algorithms, and it isn't Wall Street. It's you. Human evolution wired us to react instantly to danger. Out in the wild, that instinct keeps you alive. In the stock market, that exact same instinct destroys your portfolio. The visceral pain of losing money feels far more intense than the joy of making it. That's what forces investors to panic sell at the exact moment prices hit rock bottom. We really have to look to antiquity for the solution here. Think of the Greek hero Odysseus. He knew the siren's song would inevitably drive him mad and force him to steer his ship into the jagged rocks. He simply did not trust his future self. So while he was still in a calm, rational state, he had his crew physically bind him to the mast. We must build the exact same predetermined rules for our money before the storm hits. Here are the concrete, unbreakable guardrails you need to bind yourself to that mast. First, rebalance on a fixed schedule. Honestly, once a year is plenty. Pick a specific day, run your dual ranking formula, make your trades, and just walk away. Second, limit how often you look at the portfolio. Checking a long-term strategy daily on your phone is just inviting emotional disaster based on random, totally meaningless noise. Third, set your stock allocation in advance, say 60% stocks, 40% bonds, and only allow yourself small, agonizingly slow adjustments. We aren't pretending to be emotionless, perfectly rational robots here. We're honestly acknowledging our deeply flawed human instincts and building a rigid system that can actually survive contact with them. And this reveals the final, most profound layer of your advantage. Professional fund managers simply cannot tie themselves to the mast. Even if a highly paid Wall Street manager knows for a fact a value strategy will definitely work over a 10-year horizon, if they underperform the market for 3 quarters in a row, their clients will panic, pull their funding, and the manager gets fired. Wall Street is violently forced to think in days, weeks, and quarters due to intense career risk. But because you answer only to yourself, your ultimate superpower is the ability to think in years and decades. You can simply outweight them. So let's bring this all together. You play where the giants mathematically cannot, in the fertile ground of smaller, ignored companies. You abandon the false precision of a 30-year spreadsheet forecast for honest, relative comparisons based on today's reality. You recognize the fatal structural flaw in blindly buying what's fashionable, and instead, you build an index that uncompromisingly demands both deep cheapness and high business quality. And finally, you wrap the whole shebang in an ironclad system of behavioral discipline that protects you from your own worst instincts. That is the small investor's real advantage. It's an edge that no amount of Wall Street capital, no army of analysts, and no supercomputer can ever buy. The only question left is, now that you finally know the rules of the real game, are you brave enough to actually play it?